When we talk about credit, which is a promise to pay for something of value later, we are typically talking about either a company or an individual that's taking on that credit. A management team may wish to use credit to help grow and operate their business. Borrowing is generally either short-term in nature, perhaps in support of what we call working capital, such as purchasing inventory to sell and generate revenue. Or it may also be longer-term in nature to support investments in growing the business. We'll cover both of these categories shortly. And of course, on the other side, we have individuals, which in banking is often called retail lending. Individuals use credit. They may have credit cards for managing their day-to-day expenses, or they may have longer-term loans like car loans or mortgages. Because we are the Corporate Finance Institute, our course content will focus primarily through the lens of corporate or commercial lending, but we'll also try to provide lots of personal or retail credit examples to help illustrate important points, since they tend to be familiar for people. We often think of individuals borrowing money when they don't have enough cash on hand to make a purchase, such as a home. Most people don't pay cash for big ticket items like a house. These mortgage loans would be paid back over 25, maybe 30 years, making the monthly obligation much more manageable for an individual. When it comes to commercial credit, however, there's a little more nuance. First, there are some strategic reasons why a management team may wish to use debt in its capital structure. And second, there are also some practical reasons. We'll look at strategic reasons in the next lesson, but practically speaking, companies borrow money to make investments that will generate future revenue and presumably future cash flow. As a result, commercial lenders and credit analysts are often tasked with structuring credit such that the repayments of the loan, which are cash outflows for the borrower, align as closely as possible to the cash inflows generated by the underlying investments. And when we say investments, we don't mean stocks and bonds, but rather investments in the business, which are assets. Let's look at an example balance sheet. Management needs to purchase inventory to sell, and they must also invest in property, plant, and equipment to operate. This is known as CapEx, which is short for capital expenditures, things like manufacturing equipment, commercial real estate, and so on. Without getting too far into accounting fundamentals, assets are things that a company owns. Liabilities are things that a company owes. In this case, if you look at the liabilities section on the balance sheet, you'll see the two forms of credit we covered in the first lesson. Trade credit, here shown as an account payable, as well as bank debt, or loans, shown here as long-term debt. This means that the firm owes both its suppliers as well as its creditors. Inventory can only be sold once, making it a current asset. Current assets are those that will be converted to cash within 12 months. As a result, this current asset is typically financed using a current liability, in this case trade credit or suppliers. But it could also come in the form of an operating line from a bank. Property, plant, and equipment, on the other hand, is a category of long-term asset, meaning that the useful life is greater than 12 months. This is another way of saying that they can be used more than once and they will generate revenue for the company and cash flow for greater than 12 months. As such, credit extended to support the acquisition of these long-term assets is usually paid back over longer periods of time. There are three ways a company can fund its operations or its investments. The first is with cash that it already has on the balance sheet. If the company doesn't have enough cash, then it can either issue equity by creating new shares and selling them to investors and getting that money from those investors as cash that it can use. Or it can use credit or debt and take the money that it gets from the creditors to fund its new projects and initiatives. So these are the three sources: cash that it already has, new equity, or new credit. Let's take a look at the pros and the cons of each, starting with cash. Cash is always accepted as a source of funding for a project or a purchase. That goes without saying. It's very liquid, which means it can be accessed immediately and there's no cost to getting the cash that a company already has, other than the opportunity cost of not being able to invest it in something else. On the flip side, companies generally don't keep very large cash balances that management can access when they have a big project to execute. It's also a common strategy for management teams to try and preserve the cash that they do have in case of emergencies, more so than spending on projects. In business and finance, you'll often hear cash is king. So it's a balance between keeping enough cash for emergencies, but not leaving excessive cash that could be used to fund new CapEx. This is why it's common for businesses to seek an external source of funding for growth initiatives, like equity or debt. Now, let's look at equity. If a company doesn't have enough cash on hand already, it could consider raising equity. In order to do that, it would issue shares of its common stock and sell them to investors. This can be good for companies that don't have access to debt or that aren't able to borrow money. It's good for high-risk businesses or high-risk projects where debt is maybe not a suitable funding option. And equity does not have an ongoing requirement to pay interest, and principal doesn't have to be repaid either. But equity is more expensive than debt because it's higher risk. Since investors are taking more risk with equity, they need to be compensated with a higher expected rate of return. So even though the cost of equity is not a direct cost like interest expense or a direct use of cash like principal repayments, it's a high implied cost. By issuing equity, management is giving away ownership and control of the business, as well as their right to some of the firm's future profits. For that reason, many management teams and owners of businesses typically want to issue as little equity as they can. Once a company has issued equity to outside investors, they're accountable to those stockholders. They need to provide them with ongoing financial information, as well as access to decision-making, or perhaps even board representation, depending on how much equity is sold and to whom. Another con is that issuing equity can also be a complicated and expensive process, and is not always practical for small and medium-sized companies that are privately owned, as opposed to being publicly traded. The third potential funding source is credit, or debt. It's also good for long-term project funding, just like equity or cash. The interest payments on a credit facility are tax deductible, so using debt can concurrently reduce a firm's tax obligations. Further, unlike equity, borrowing money won't dilute existing shareholders or change the ownership structure of the company. It's also cheaper than equity because it's a lower risk source of funding. More on this next lesson. So you can see there's definitely a strategic rationale for employing debt to support a company's growth plans. On the flip side, when a business uses debt, management must pay very careful attention to liquidity. Interest and principal repayments must be made, and so managing cash flow becomes imperative. Also, if the company is somewhat higher risk, it's possible that the interest rate could be quite high. Debt also adds financial risk to a business. Debt can cause serious solvency issues, unlike equity, which cannot push a company into default or insolvency. And finally, debt also sometimes comes with certain restrictions called covenants. These are sort of like rules set in place by a lender, stipulating things that the borrower can't do or must do in order to help manage credit risk. So, in summary, companies trade off between these three sources of funding, but you can see some clear strategic reasons why a management team may wish to use debt instead of equity as a preferred source of external funding. With the understanding now that debt and equity are the only two external sources of funding available to a company, let's touch on why debt is considered a lower risk and therefore a cheaper source of capital than equity. The best way to help visualize this is through a corporate finance concept called the capital stack, where you can visualize different funding sources being stacked on top of each other. The higher a funding source is on the capital stack, the more senior it is, and therefore the lower risk it is from the perspective of that capital provider. The lower it is in the capital stack, the higher risk it is. While there are a variety of unique, hybrid, and sometimes exotic funding sources, like subordinated debt, mezzanine financing, preferred shares, and so on, they all basically fall into the two main categories we already covered, equity and debt. At the very bottom of this capital stack is equity, common shares specifically. At the very top is debt, senior debt specifically. Because of this seniority, earnings are paid out to creditors ahead of stockholders, both in good times and in bad. And here's what we mean by good times. If you look at this example income statement, you'll see a healthy, profitable company. You'll notice that interest is paid out of EBIT, earnings before interest and taxes here. Then taxes, and then common shareholders are paid finally their dividend last out of the net earnings, after interest and taxes, all the way down at the bottom of the income statement. And what do we mean by bad times? Well, a creditor, be it a bank, an equipment finance firm, or a different private non-bank lender, registers a charge against its borrower's assets, which makes them collateral. This means that by way of a public registry, which varies by jurisdiction, it's made publicly known that this lender has a charge over some, or perhaps all, of that borrower's assets. In the event that this company stopped making loan payments and ceased operations, claims against the company's assets would be made and paid in priority from the top to the bottom of this capital stack, meaning that the most senior lenders get to grab, seize, and sell the collateral assets first to recoup outstanding loan proceeds, followed by whichever capital provider is below them in the capital stack, and so on. You can imagine that by the bottom of the stack, there's not much left in the way of residual assets for common shareholders. This is what we mean when we say that debt is a less risky source of funding than equity, since when everything falls apart, creditors have a much better chance of getting repaid their principal, whereas equity investors do not. This is another reason why their return expectations are that much higher. Broadly speaking, there are three main types of credit: revolving, installment, and open credit. Revolving credit is often a line of credit or a credit card that has a capped limit, and you can use it up to that limit. There may be a minimum payment requirement, but there's not a fixed repayment schedule, meaning it can be drawn, paid back, and then again redrawn up to its limit. Then there's an installment loan, which does have a predetermined payment schedule. These loans are often given for a specific period of time, for example, a 30-year mortgage or a 5-year car loan. For a commercial borrower, these might be a 5, 6, or 7-year equipment loan, and so on. These types of loans are often called reducing or amortizing, since the principal outstanding reduces with each repayment. And then, finally, there's open credit. This is how a good deal of trade credit is structured in B2B, or business-to-business transactions. With open credit, a vendor extends to its buyer the ability to use its products or services on credit, but that amount is typically due in full at the end of some period. So for trade credit, that means by the end of the payment term, maybe 30, 45, or 60 days from the date an invoice is issued. A non-business example is a utility bill, or maybe a cell phone bill. Individuals use their cell phones as well as utility services like electricity and water all month. Then their bill is due at or near the end of that month. This is a very common form of open credit. Loan payments consist of two parts: principal and interest. Principal is the face value of the credit that's being extended and which must be repaid in full at some point. Interest is the additional charge on top of the principal amount that's paid as compensation to the lender for providing the capital. So, for example, if a $1 million credit facility was extended to a business on a 5-year amortization, assuming the loan was an equal amortizing loan, then $200,000 in principal would be due each of the 5 years until the remaining balance was zero. With interest, we're looking at the fee or the expense that's being charged as the cost of making the loan, and this is paid over and above the principal amount. Interest is what compensates the lender for taking on the risk of lending out that money, and it's calculated as a percentage of the outstanding loan principal. Well, there's a lot more to the mechanics of loan pricing, which you can explore in CFI's loan pricing course. As a general rule, the higher the risk of the borrower, or the higher risk the nature of the transaction, the higher the interest rate will be to compensate for that incremental level of risk. Interest is expressed as a percentage of the outstanding loan principal, like 2%, 5%, 10%. Interest rates are also most commonly quoted as an annual rate, even if payments are made monthly or otherwise. There are a few different types of interest. We'll explore each in the next few lessons, but as a rule, interest is either regular or accrued, and it's either simple or it's compounding. To illustrate the different types of interest, let's work with an example $1 million loan on a 3-year term at 5% interest, with interest charged annually, although there are no principal repayments. Let's assume the entire principal amount is due at the end of year 3. If this is a regular interest loan, then a cash payment is made at the end of each period. In this case, that's at the end of year 1, year 2, and year 3. For our example borrower, that means a $50,000 cash payment. 0.5 times 1 million equals 50,000 at the end of each year. That's also an example of simple interest. Simple interest is best explained as interest calculated on the original principal amount of the loan. So, expanding upon our example, at the end of year 2, this borrower, making regular interest payments, would owe another $50,000 in cash interest expense. Same at the end of year 3. Simple interest is additive. The cumulative amount of interest paid after year 3 of this loan term is $150,000. 50 plus 50 plus 50. Accrued interest is the opposite of regular, meaning rather than making a regular cash payment at the end of each year, the interest owing would instead accrue or accumulate and would be due at the end of the term. Accrued interest is often referred to as a pay-in-kind structure, or PIK. But with an accrued interest structure, simple interest doesn't make sense. Think about it. The lender wouldn't see a single dollar of interest or principal until the end of year 3, in our example. That's where compound interest comes in. Compounding is when interest is charged on top of interest. The formula for calculating compound interest is P times 1 plus I to the power of n minus 1, where P equals the original principal amount, I equals the nominal interest rate, and n equals the number of periods. In our example, this is 1 million times 1 plus decimal 0.5 to the power of 3, all minus 1, which equals $157,625. You'll note that this is more than in our additive simple interest example, which makes sense since interest is being charged on interest that's being accrued. In our example, that's another way of saying that the loan principal continues to get larger at the end of each period. Since we're only talking about 3 years, I can actually illustrate this year by year. At the end of year 1, the borrower owes $50,000, which we add to the million outstanding. At the end of year 2, they owe 5% again, but this time 5% of $1,050,000, which is $52,500. Add that to the $1,050,000, and the borrower owes $1,102,500 at the end of year 2. At the end of year 3, we now multiply this amount by 1 plus decimal 0.5, since the principal is due 2, and we get $1,157,625, which, less than $1 million in principal owing, is the same interest figure we calculated earlier using our compound interest formula. As a matter of practicality, accrued interest structures are virtually always charging compound interest. For regular interest payments, They can be either compound or simple interest. There's no hard and fast rule. Loans can have a variety of different characteristics. And what's interesting is that a skilled credit professional, like a commercial banker or an analyst, can actually mix and match different characteristics to customize what we call a loan structure, based on the nature of the credit request and the perceived level of risk of the borrower's business. Broadly speaking, loans can be structured as a fixed rate or as a variable rate, sometimes called floating, as operating credit or as term financing. If a loan is of the term financing variety, it can be either amortizing or non-amortizing, again, often called reducing or non-reducing. And credit can either be secured or it can be unsecured. Let's look at each in turn. Let's compare fixed rate and variable rate loans. With fixed rate loans, the interest rate remains the same over the loan term. With variable rate loans, the interest rates are set relative to a reference rate. The reference rate is often what's known as bank prime, which, as we know, changes over time. It can go up and it can go down, informed largely by macroeconomic factors and central bank policy during a given period. Let's look at an example of a fixed rate loan. The interest rate does not follow the changing rates in the market, as you can see in the chart. And if you look at the table, you'll see that each year as the reference rate changes, the interest rate on this fixed interest rate loan remains at exactly 5%. Now, let's look at an example of a variable rate loan. You can see in the chart that the interest rate on the loan follows the reference rate, and you'll notice that the difference between the two lines is the same over time. By looking at the table, you'll see that the difference between the two lines is called the spread, and that is set in this example at exactly 2%. While we won't cover the specifics in this course, you should know that the spread on a loan is a function of the borrower's level of default risk. You'll see when the underlying reference rate is 5%, the all-in client rate on this loan is 7. When the underlying reference rate moves to 5.75, after adding the 2% spread, the all-in client rate on that loan is 7.75%, and so on. So let's look at why a borrower might want either type of loan. With a fixed rate loan, it protects them from rising interest rates in the future. So if the borrower's management team is worried about rising rates, then they may seek out a fixed rate on their credit exposure. It also makes it much easier for the borrower to plan for future payments when building forecast models. On the flip side, it's worse for the borrower if interest rates fall in the future, as management is locked into a specific rate. It also limits flexibility if the borrower wishes to repay the loan early. There are generally steep cash costs to breaking a fixed rate loan, often called breakage costs. With a variable or floating rate loan, there's the ability to capitalize on a reference rate decrease over time, assuming management thinks that this will be the case. In general, variable permits early payouts too, and therefore maximum flexibility for a company's management team. It's worse for the borrower, though, if the reference rate rises over time. When it comes to operating credit versus term financing, let's think back to the lesson on how and why credit is used. A skilled credit professional will always structure financing according to the nature of the underlying assets being financed. In general, current assets, like our inventory example earlier, as well as accounts receivable, will be financed using a current liability, while trade credit, or accounts payable, count as current liabilities. When it comes to bank financing, we're typically talking about an operating line of credit, sometimes called a revolving line of credit, or even just a revolver. It's operating credit because it supports day-to-day operations, and it revolves more or less daily, depending on the changing balances of working capital accounts like receivables, inventory, and payables. Many long-term assets are lumped into one category on the balance sheet called property, plant, and equipment, or PPE. This category commonly includes equipment and commercial real estate, as well as physical improvements that have been made to any buildings in which these businesses have operations. Other examples of long-term assets include investments in, often subsidiary businesses, as well as goodwill, which is a byproduct of merger and acquisition activity. When credit is used to support these acquisitions, it's typically structured as term financing, meaning that it comes with a predetermined fixed repayment schedule, as opposed to revolving operating credit. The length of the repayment term is largely determined by the useful life of the underlying asset or assets that are being financed, as well as the nature of the credit request. When financing is of the term variety, meaning it's not operating credit, it can be structured as either amortizing or as non-amortizing, again, sometimes referred to as reducing or non-reducing. With amortizing loans, the principal payments are spread out over the life of the loan. As a result, the principal balance decreases over time as principal repayments are made, and it's designed to be fully repaid by the maturity date. Principal payments may be the same each period in what's called an equal amortizing loan, or the principal amount may vary month to month if the loan's what's called an equal payment loan. This is what many personal borrowers are most familiar with. We'll look at an example of each in the coming lessons. In fact, we'll build an amortization schedule for both, so you can really get a sense of how they work. With a non-amortizing loan, the full repayment of principal is made at the end of the loan term with a bullet payment. If it's an accrued interest structure, as we discussed, then the total accrued interest is also due at the end. If it's a regular interest structure, then cash interest payments are still made at predetermined intervals along the way, probably monthly or quarterly. So why might a borrower consider one of these alternatives versus the other? Well, with amortizing loans, the principal reduces along the way, so the borrower doesn't have to pay as much interest over the life of the loan. If you were to add up the total interest paid in a reducing loan versus a non-reducing loan, it would be lower. From the lender's perspective, reducing loans are also less risky, since they receive a small portion of principal each period along the way, meaning that repayment risk is lower as the term progresses. Why might a borrower prefer a non-amortizing loan then? Well, even though they pay more interest over the course of the term, the payments that are made along the way will be much smaller because there's no principal, only interest. In fact, there may be no payments at all if it's accrued interest. Non-amortizing loans are generally preferred by fast-growing companies that need to preserve cash in the short term for reinvestment. For example, from a lender's perspective, while repayment risk is higher because all principal is being returned sometime in the future instead of monthly throughout the loan term, the potential return is greater since the total interest paid is higher. As we discussed earlier in the course, a commercial lender will register charges against its borrower's assets using public security filings. These assets are what we call collateral security, and the lender can use this collateral to sell and recover loan proceeds if the borrower ever defaults on its exposure. While the nature of the charges vary by country, it's common to use something like a general security agreement or a GSA, which is a floating charge over all the borrower's assets. In this sense, it's very rare to see truly unsecured commercial lending, since credit is virtually always backstopped by a general security agreement. What we mean by a secured loan is that some credit is backstopped by a specific charge over a specific asset. A great example is a commercial real estate loan. Any credit outstanding to support the acquisition of commercial property will be secured by that property itself, using something called a collateral mortgage agreement. Another is manufacturing equipment or machinery, like a forklift maybe. If a loan is extended to support the acquisition of machinery, the lender may wish to secure its exposure by registering a charge over the specific serial number of that machine. So when we talk about unsecured credit in commercial lending, what we generally mean is credit that is not secured by a specific asset, but rather by the creditworthiness of the borrower and by its general asset base. Truly unsecured credit does exist, however, in personal lending. Think about a credit card, for example. A student line of credit, too, has no specific underlying asset. Secured credit is also common in retail borrowing, like home mortgages and car loans. In general, and all other factors being equal, secured credit tends to have a lower interest rate than unsecured credit, since a strong and specific collateral position makes the risk of loan loss a little lower. There's a fairly predictable process through which credit gets extended to a borrower. We'll use a bank for illustration. First, a representative from the bank will originate new business. This could be through cold calling, a referral, or one of many other strategies used to source deals. Once they've identified an opportunity, they go through a client discovery process where they seek to understand the business, its financial results, and the prospect's borrowing need or needs. At this stage, a good deal of early negotiations will begin around things like credit structure, including the loan features we covered earlier, as well as pricing and fees. Once you have the client's commitment to move forward with your firm, the actual analysis and underwriting begins, often called due diligence. This stage includes the credit application and formal approval from your firm's risk management or adjudication group. They're sometimes also called a credit committee. After an approval is secured, the parties move into the documentation stage, which includes perfecting security. This is where all the loan and collateral agreements are produced, reviewed, and executed with the support of both parties' legal counsels. And finally, the proceeds are advanced, and the loan hits the books of the financial institution. For credit professionals in a more analytical or transactional role, like analysts and risk managers, the process is sequential like this, and they move on to the next deal. For those in a relationship management role, however, you might visualize this process as more of a cycle. See, once credit is advanced, they're also responsible for managing the relationship, which, if done well, should result in originating more opportunities to begin the cycle again, either additional borrowing for the same company or through referrals to other business clients and other lending opportunities. The 5 C's is a foundational framework used by lenders when analyzing and assessing the creditworthiness of a borrower. The 5 C's stand for character, capacity, capital, collateral, and conditions. Character is a lens through which analysts try to understand what the business is all about. Basically, what's the character of the company? Considerations like competitive positioning and strategic advantages, as well as what is the business, and perhaps more importantly, its management team and ownership's reputation within the business community. Analysts may use past repayment history as a proxy for strong character, as well as cues like leadership in corporate social responsibility initiatives. Management's history of successfully operating and growing companies fits here as well. Capacity speaks to the borrower's actual capacity to service debt obligations, including considerations around profit margins, liquidity, and whether cash flows can support principal plus interest payments into the future. Capital is a lens to evaluate the company's financial structure, often referred to as its capital structure. Capital structure is about understanding the proportion of debt versus equity financing. A big part of the capital analysis also includes the business or its ownership's access to other sources of capital, like related party loans, shareholder cash injections, or the ability to raise new equity from outside investors. Questions around collateral include what types of underlying assets are being financed, and are there other assets potentially available too? Where are they physically located? How easily could a lender seize and sell these assets to another party if required? And finally, conditions. This lens is used to evaluate credit requests within the broader context of what's happening in the industry in which the business operates, as well as the broader macroeconomic environment. Things like inflation, consumer spending, interest rates, foreign exchange rates, and so on. When it comes to analyzing and underwriting a loan request for a commercial borrower, having the right balance of the 5C characteristics is very important, but there's no one-size-fits-all. For example, you may get a borrowing request from a firm that has a very weak collateral position, but perhaps they have terrific margins and cash flow, capacity, and maybe management has 15 years of industry experience and a strong reputation for timely payments, character. When taken collectively, these strengths in two categories could offset the weakness in collateral and still make good business sense as a loan candidate. Another example, consider a credit request from a family-owned business in a very challenging industry, like print media, let's say. It's very much a declining industry. Conditions. However, perhaps the collateral security available is rock solid. And let's assume this family has lots of other business interests and significant cash available to inject into the company should it be required. In this example, strength in the collateral and capital Cs might be sufficient to offset weakness in conditions. As a commercial lender, our borrower is a company, and part of quantifying credit risk is understanding that business really well. In order to do so, at the company level, we would seek to understand, among other things, its competitive position and its management capabilities, and we would conduct extensive financial analysis too, including understanding the amount of, the nature of, and the availability of any collateral security within the context of the borrowing request. But as we know, companies operate within an industry, all of which exist in the broader economy or the external business environment. Are you beginning to see how the 5 Cs fit? They all start to come together here as we look to paint a very comprehensive picture of a borrower's credit risk profile. For this course, though, let's bring these frameworks to life at a high level by touching on some tools and resources, as well as some key financial ratios used in the credit analysis process. The final C to address here is collateral. As a general rule, any collateral is usually better than no collateral. However, and as you probably imagine, not all security is created equally. This is important because the desirability and the overall quality of physical assets being pledged as collateral will influence some important borrowing parameters. The first is loan to value, or LTV. If a borrower pledges cash as collateral, for example, they may get 100% loan to value, meaning dollar for dollar. Where if they pledge used equipment, they may only get 50% loan to value, or 50 cents on the dollar. A common tool used to understand and measure the desirability of an asset as collateral is the MAST framework. MAST asks, is the asset marketable, ascertainable, stable, and transferable? And if so, to what extent? Marketable implies there's an active secondary market, like stocks and bonds. If an asset's value is ascertainable, it means that many parties can agree upon its value, often by using a third-party appraiser. Think commercial real estate. Intellectual property, on the other hand, may not have an active secondary market, and its value depends largely on the ability of the party that possesses it to monetize it, making it inherently hard to value. Stability is important as well. After all, a lender doesn't want to extend 75% loan to value against an asset that could decrease in value by 50% in a week, leaving a collateral shortfall. This makes cryptocurrencies undesirable collateral for most traditional lenders. And finally, there's the asset's transferability, meaning how easy is it to transfer title? Physical machinery is generally marketable, ascertainable, and stable. But it may not be all that transferable if the borrower is a nickel miner and the equipment is at a remote mine site on a different continent. Any costs associated with realizing on physical inventory must be considered in the assessment of collateral value. As a general rule, the better an asset scores against the MAST framework, the more flexible and favorable the loan structure can be, including loan-to-value, amortization length, and often pricing too. Financial ratios are how we seek to understand and evaluate a company's overall financial health. Liquidity speaks to a borrower's ability to cover current liabilities and obligations, those due in the current fiscal year, with its current assets. Common metrics include the current ratio and the quick ratio. Capital structure refers to the makeup of a company's funding sources. As we discussed earlier, assets are financed using a combination of liabilities and equity, or debt and equity. A capital structure with a higher proportion of debt is said to have high leverage, sometimes called gearing. Debt to equity is a pretty common ratio. Many lenders will also look at debt to tangible net worth, which is equity less assets that have no underlying tangible value in the denominator. Coverage metrics assess how easily a business can cover its annual interest or interest plus principal obligations using its annual operating cash flow. Common ratios include EBIT over interest, debt service coverage, often abbreviated to DSC, and fixed charge coverage, or FCC. All other things being equal, higher liquidity and coverage ratios and lower leverage ratios tend to correspond with a lower likelihood of default. But like performance metrics, we don't look at them in isolation. Credit professionals must conduct trend analysis as well as benchmarking against industry peers in order to paint a more complete picture of the borrower's financial health. Understanding a borrower's performance and financial ratios help to satisfy the capacity and the capital C's of our 5 C's framework.